Welcome back. In our first two videos, we explored how to get your business ready for finance and how to present it in the best light to lenders. In this video, I'll walk you through the 6 most common types of business finance, what each one typically requires, and what you can do to get a better interest rate when you're applying. It's important to understand your options because choosing the wrong finance solution can cost you time, money, and flexibility. On the other hand, choosing the right finance solution, one that aligns with your business model, your growth plans, and your cash flow, can give you the boost that you need without unnecessary risk. Remember, this isn't just about getting approved for any loan, it's about getting the right loan on the right terms for your specific situation and at the best interest rate available. So let's jump in. Secured business loan. A secured business loan is a type of finance where you, the borrower, offer up an asset, like a vehicle, piece of equipment, or even a property, as the security. That means if for any reason you can't repay the loan, the lender has the right to recover their money by selling that asset. This setup lowers the lender's risk because they have something tangible to fall back on if things go wrong. That's why lenders tend to be more confident when offering secured loans. They're not just relying on your credit history or cash flow projections, they've got actual security to back the deal. As a result, they're usually more willing to lend larger amounts and often at much lower interest rates. This makes secured loans a very strong option for businesses looking to make significant investments, whether it's for expansion, equipment upgrades, or a big one-off purchase. It's all about giving the lender peace of mind, and in return, you get more favourable terms. Unsecured business loan. An unsecured business loan is a type of financing that doesn't require the borrower to pledge any assets or security, like property, vehicles, or equipment. Instead, approval is typically based on the creditworthiness of the business, its trading history, and sometimes the personal guarantee of a director or owner. Now, because there's no physical security backing the loan, lenders take on more risk, so interest rates may be higher, and loan amounts might be smaller compared to secured loans. Unsecured loans are often used for short-term needs like boosting cash flow, funding marketing, or covering operational expenses, but can be used for almost anything. Invoice finance. Invoice finance, sometimes called factoring or invoice discounting, is a way for businesses to unlock cash tied up in unpaid customer invoices. Instead of waiting for 30, 60, or even 90 days for your customers to pay, a finance provider gives you an advance on those outstanding invoices. Then, when the customer eventually pays, that money goes to the lender to settle things up. Invoice finance is particularly useful for smoothing out cash flow, especially if you're in an industry where payment terms are long or you've got a lot of money tied up in receivables. The security here comes from your customers themselves, so lenders will look at things like how reliable your customers are, how many different customers you have, and how quickly they typically pay you. If your debtor book is strong and well diversified, you're more likely to get better rates. It's an excellent tool for businesses that are growing fast and just need that extra breathing room between doing the work and getting paid. Asset finance. Asset finance is a type of business funding that helps you get the equipment, vehicles, or machinery you need without having to pay for it all up front. It's especially helpful if you're looking to upgrade or expand but want to keep cash in the business. And the great thing is that the asset you're buying typically acts as the security for the loan. And that means if things go wrong and repayments can't be made, the lender can take back the asset to recover their costs. It's because of this built-in security that lenders see asset finance as much lower risk than an unsecured loan. And when the risk is lower, interest rates are more competitive. It's a practical and cost-effective way to invest in the tools that your business needs to grow without putting pressure on your working capital. Merchant cash advance. A merchant cash advance is a flexible way to get funding if your business takes payments through a card terminal or online. Instead of fixed monthly repayments, the lender takes a small percentage of your daily or weekly credit card sales. So you can repay more when business is booming and less when things are quiet. It's not technically a loan, but rather an advance on your future sales. This type of finance can be really useful for short-term cash flow boosts or quick growth opportunities, especially if your income is consistent. However, if your sales are unpredictable or your business is quite new, lenders may view it as higher risk, and that can lead to higher costs overall. Still, for the right business, like retailers, salons, or hospitality businesses with steady card revenue, it's a really fast and flexible way to access funds without needing physical security or a perfect credit score. Commercial mortgage. A commercial mortgage is a type of loan used to purchase or refinance commercial property, where the property itself is used as the security for the loan. This means the lender has a legal claim over the property until the loan is repaid. Because it's a secured form of borrowing, the interest rates are typically lower, much like a residential mortgage, since the risk to the lender is reduced. Businesses usually take out commercial mortgages to buy new premises, to expand their current location, or to refinance an existing property in order to release equity and give them access to working capital. When applying for a business loan, there's one key thing to remember. The more security you can offer, the lower the risk for the lender, and the better your interest rate is likely to be. Lenders are essentially betting on your business, so if things go wrong, they want to know there's a safety net. Whether it's business assets, your invoices, property, or a personal guarantee, strong security shows that you're serious, and this gives lenders confidence there's a backup plan in place. Less risk for them means better terms for you. It's not just about ticking boxes, it's about building trust. And in a competitive lending market, that trust can be the deciding factor. I'm Guy from First Oak Capital. I hope this helped give you clarity on how finance options do vary depending on the security given. In the final video, we'll dive into how to find the right lender and how to get the best possible deal for your business. And as always, if you need a hand, we're here to help.